Hi, welcome back. If you have been watching gold and silver over the last few days, you have probably noticed something that feels a little strange. Prices that were climbing with so much confidence just weeks ago are now sliding back, and a lot of people are asking the same question. Did something break? Is the rally over? Or is this just the market catching its breath before the next move? Today we are going to slow down and walk through exactly what is happening, why it is happening right now, and what it actually means for anyone who owns metal, is thinking about buying some, or is simply trying to understand where the bigger picture is heading. Let's break this down from the start. Two forces have been pulling on gold and silver at the same time, and both of them shifted in the last little while. The first is the Federal Reserve, and the uncertainty around its next interest rate decision. The second is the situation in the Middle East, where signs of de-escalation have taken some of the fear premium out of the market. When you put those two things together, you get a pullback that feels sharp, even though the underlying story for metals has not actually changed. Let's start with the Fed, because this is the piece that trips up the most people. Interest rates matter enormously to gold and silver, and here is the simple reason why. Gold and silver do not pay you interest. If you hold a bond or keep cash in a savings account, that money earns something over time. Gold just sits there, quiet, waiting. So when interest rates are high, holding gold means giving up a real, measurable return you could have gotten elsewhere. That is called an opportunity cost, and it is one of the oldest relationships in the world of investing. When rates are expected to fall, gold becomes more attractive, because the competition from cash and bonds gets weaker. When rates are expected to stay higher for longer, or when the path forward becomes foggy and uncertain, gold often cools off, because that competition suddenly looks more appealing again. Right now, the market is not fully sure what the Fed is going to do. Recent economic data has been mixed. Some numbers suggest inflation pressures are still sticky, while others hint that the economy is slowing down enough to justify a rate cut. This is exactly the kind of environment traders hate, because it is unclear. Think about it this way. Imagine you are planning a road trip, and the weather forecast keeps flipping between sunny and stormy every few hours. You would probably hesitate before packing the car, right? That is what is happening with big institutional money right now. Traders are hesitating, some are taking profits off the table after the recent run-up, and others are simply waiting on the sidelines until the Fed gives a clearer signal. That hesitation alone can cause prices to drift lower, even without any dramatic new negative news. Now let's bring in the second piece of the puzzle, the Middle East situation. Over the past several months, tensions in that region have added what analysts often call a fear premium to gold prices. This means part of the price was not really about supply and demand for the metal itself, it was about people wanting a safe place to park money in case things escalated further. Gold has played that role for centuries, long before modern financial markets even existed. It is portable, it is universally recognized, and it does not depend on any single government or company staying stable. So when headlines suggested growing risk of conflict, some investors moved money into gold simply as a hedge against the unknown. Now here is what this means for the current pullback. As diplomatic conversations have shown signs of progress, and as the immediate risk of a wider conflict has appeared to ease, some of that fear premium has started to come out of the price. This is not unusual at all. It happens almost every time geopolitical tension rises and then cools down. The metal does not lose its long-term value, but the short-term safety demand fades a little, and that shows up as a price correction. It is a bit like an insurance policy. When the storm warning gets canceled, some people cancel the extra coverage they just bought because the immediate reason for it has passed. So you have these two things happening together. Interest rate uncertainty is pulling money toward the sidelines, and reduced geopolitical fear is pulling some of the safety demand back out. That combination is enough to explain a real noticeable drop in both gold and silver prices without needing any dramatic explanation involving hidden agendas or secret manipulation. Markets move because expectations shift, and right now expectations are shifting in a way that favors a pause rather than a straight line up. Let's talk about silver specifically for a moment, because silver tends to move even more sharply than gold in situations like this. Silver has 1 foot in the world of precious metals and 1 foot in the world of industrial demand. It gets used in solar panels, electronics, electric vehicles, and a wide range of manufacturing processes. That dual identity means silver often amplifies whatever gold is doing, When gold goes up, silver frequently goes up faster. When gold pulls back, silver often pulls back harder too. This is sometimes described using something called the gold-to-silver ratio, which simply measures how many ounces of silver it takes to equal the price of 1 ounce of gold. When that ratio swings quickly, it tells you that silver's move, in either direction, has outpaced gold's move. That kind of volatility is completely normal for silver and has been part of its character for a very long time. Now this is important because it helps explain why some viewers might be feeling a bit of whiplash watching their portfolio or their local dealer's premiums shift day to day. A short-term pullback after a strong rally is not automatically a sign that something is fundamentally wrong. Markets rarely move in a straight line. They tend to climb, pause, pull back a little, consolidate, and then decide on their next direction based on new information. What we are seeing right now looks very consistent with that kind of normal, healthy pattern rather than the beginning of a collapse. Let's step back and build a simple mental framework you can use anytime you see a move like this happening in the metals market. Ask yourself 3 questions. First, has anything actually changed about the long-term supply and demand story for the metal? Things like mine production, industrial usage, or central bank buying patterns. Second, has the interest rate outlook shifted in a way that changes the opportunity cost of holding a non-yielding asset like gold? Third, has the geopolitical risk premium changed because the world genuinely feels safer or more dangerous? If the answer to the first question is no, and the moves are really being driven by questions 2 and 3, then what you are usually looking at is a repricing of short-term expectations, not a change in the underlying value proposition of the metal itself. Before we go further, if you are finding this kind of clear, no-hype breakdown useful, consider subscribing so these videos keep reaching you, and feel free to drop a comment with your own thoughts on where you think this is headed. It genuinely helps to hear different perspectives from people watching the market in real time. There is another layer to this that is worth understanding because it explains why the reaction in the market can sometimes feel bigger than the actual news itself. Financial markets do not just react to what has already happened, they react to what people expect to happen next. This is why you will often hear traders and analysts talk about something being priced in. If the market had already assumed a certain outcome for the Fed decision, and then new data comes out suggesting a different path, prices can move quickly to catch up with that new expectation, even before the actual decision is announced. The same logic applies to the Middle East situation. It was never really about a single headline, it was about a broad shift in how much risk the market believed was sitting out there. As that perceived risk came down gradually, the price adjustment happened gradually too, rather than all at once. Understanding this idea of expectations versus reality can help you make sense of a lot of market movements that otherwise seem confusing or exaggerated. Let's talk about the other side of this story too, because it would not be fair or accurate to only focus on the reasons for the pullback. There are still real, structural factors supporting demand for both gold and silver over the medium and long term. Central banks around the world have continued adding gold to their reserves over recent years, a trend that has been well documented and is often tied to a broader desire among some nations to diversify away from being overly dependent on any single currency. Industrial demand for silver tied to renewable energy, electric vehicles, and advanced electronics has also remained a consistent theme, independent of what happens with any single Fed meeting or news cycle. None of that disappears just because prices pulled back for a few days or weeks. At the same time, it is worth acknowledging some genuine uncertainty and offering a fair, balanced view of what could happen next. If the Federal Reserve does move forward with a rate cut, and if that decision comes with language suggesting more accommodation ahead, it is reasonable to expect renewed interest in gold and silver as the opportunity cost argument shifts back in their favor. On the other hand, if inflation data surprises to the upside, or if the Fed signals a more cautious wait-and-see approach, metals could remain under pressure for a bit longer, or even see further consolidation. Similarly, if geopolitical tensions in the Middle East were to flare back up unexpectedly, some of that fear-driven demand could return just as quickly as it left. Nobody can predict these outcomes with certainty, and anyone who tells you they know exactly what is going to happen next is not being fully honest with you. Let's connect all of this to something more personal because at the end of the day, price charts and Fed statements only matter to the extent they affect real decisions people make with their own money. For someone holding physical gold or silver as part of a long-term saving strategy, a short-term pullback like this is simply part of the journey. Similar to how a long-term stock investor expects to see dips along the way without abandoning their overall plan. For someone who has been sitting on the sidelines wondering if they missed their chance, moves like this are often a reminder that opportunities in this space tend to come in waves rather than in a single narrow window. And for everyday households simply trying to understand the news, this kind of pullback is a useful lesson in how interconnected today's financial world really is, where a single Federal Reserve meeting on the other side of the country, or a diplomatic development thousands of miles away, can ripple into the price of a metal that has been valued by human civilization for thousands of years. It is also worth remembering that short-term price action, whether up or down, does not need to dictate your entire outlook. Zooming out over longer stretches of time tends to smooth over these individual dips and spikes, revealing a much steadier underlying trend shaped by things like currency strength, global debt levels, and overall investor confidence in traditional financial systems. That is not a promise about what will happen next. It is simply a reminder that context matters more than any single week of price movement. So where does this leave us heading into the actual Fed decision? The most likely scenario, based on everything we have discussed, is that markets will remain a little jumpy and reactive in the days leading up to the announcement. Traders will be parsing every word of the Fed's statement, looking for hints about future policy direction rather than just reacting to the headline decision itself. Volatility in gold and silver prices during this window would not be surprising at all, in either direction. What matters more than the day-to-day swings is understanding the two big forces we talked about today: interest rate expectations and geopolitical risk perception, and recognizing how they interact with each other to shape short-term sentiment around these metals. One more thing worth mentioning is the role of simple market psychology during moments like this. After a strong rally, it is completely natural for some investors to lock in gains, even if their longer-term view on gold and silver has not changed at all. This kind of profit-taking is not a vote against the metal, it is just ordinary portfolio management. Think about it this way: if you took a trip somewhere and had a wonderful time, you would not conclude that the destination was suddenly a bad place just because the trip eventually had to end. The same logic applies here. A pause after a run-up does not undo the reasons people were interested in the first place. It simply reflects the natural rhythm of buying and selling that happens in every market all the time. Let's bring this together with a clear summary. Gold and silver have pulled back recently for two main, understandable reasons. Uncertainty around the Federal Reserve's next move has increased the appeal of holding cash and interest-bearing assets in the short term, and signs of easing tension in the Middle East have reduced some of the safe haven demand that had been supporting prices. Neither of these developments changes the longer-term structural story around central bank buying, industrial demand, or the historical role these metals have played as a store of value. Markets move in cycles, driven by shifting expectations, and what we are seeing right now looks like a normal part of that cycle rather than a fundamental turning point. As always, none of this should be taken as a signal to buy or sell anything. It is simply meant to help you understand the moving pieces so you can form your own informed view. Thank you for spending this time with me today. If this breakdown helped clarify what is going on with gold and silver right now, I would really appreciate a like, and if you want more clear, grounded explanations of what is actually driving these markets, subscribing helps make sure you do not miss the next one. I will see you in the next video.